Hello friends, welcome back. So we are starting with the question number 2 for fire insurance claim. On 20th March 2019, a fire occurred and destroyed all the goods of Shalini Traders except worth of 2000. So this would be your salvage, the goods which are saved. So we can just write over here salvage. The stock was insured against the fire to the extent of 40,000. So this is your policy value. The following particulars could be obtained from the books and records saved. Balance as per balance sheet as on 31st December 2018. Stock 66,000, debtors 1,25,000 and creditors 85,000. Other information regarding suppliers and customers. So suppliers is your creditors, customers is your debtors. Bills payable, receivable, goods returned, discount, remittances and dues on the date of fire. Transaction between 1/1/19 to 20th March 19. So 20th March is your date of fire. So this is from the first day till the date of fire. Wages 27,000, cash purchases 12,000, cash sales 35,000. Goods sent on consignment remaining unsold with the consignee at cost plus 10% is 11,000. Goods given to disaster relief fund at cost is 15,000. Goods taken by proprietor at sales value 8,000. Free samples distributed at cost is 500. Goods are sold at gross margin of 30%. So this is your GP ratio given. Since the GP ratio is given, we are not required to prepare previous year's trading account to find out GP ratio. Stock for the balance sheet date as on 31st December 18 was valued at 10% above the cost. Compute the insurance claim on the basis of data gathered as above. Now if you see this question, they have given you opening stock. Now what they have given you? Stock for the balance sheet date as on 31st December 18. So this stock, they are talking about this stock of 66,000 was valued at 10% above the cost. So there is some adjustment over this. Now we had discussed this, whenever the goods are valued above the cost or under the cost, we have to always bring our stock at cost, because we are finding out the stock cost of stock on the date of fire for which we file a claim to the insurance company. So on this stock we'll have to do adjustment. Again, if you see, they have given you debtors, creditors figures. They have given you all the transactions with debtors and creditors. But in this question, they have not given you credit sales and credit purchase figure. So guys, this you always have a thought that whenever they give you debtors, creditors figures, opening figures and all the transaction with the debtors, creditors, always see whether there is a credit sales or credit purchases. If that is not given, you'll have to prepare debtors account and creditors account to find out credit sales and credit purchases. They have directly given you cash sales and cash purchases, and they have also given you some adjustments below this. So we'll start with this question. First of all, we are not preparing previous year's trading because GP ratio is directly given. Again, in this GP ratio, this is 30%. If nothing specified, it is always on sales. Gross profit, your formula for gross profit is gross profit upon sales into 100. So since gross margin is given as 30%, it is on sales. So starting with the first, opening stock. Now in the books of Shalini Traders, we will prepare memorandum trading account. This is not your actual trading account. From first day of the accounting period, that is 1/1/19 to till the date of fire, that is 20th March 2019. So two opening stock. Since there is an adjustment, we write in the inner column 66,000. Next we have debtors and creditors. So guys, what you do in your exam, you leave some space for your trading account depending on the adjustments. So you can leave the half page or 3/4 of the page for your trading account. Then also leave some space for finding actual loss and claim. We do 3 steps: stock on date of fire, actual loss and claim amount. So leave some space for that and then start with your working notes. In this working notes, I have already prepared debtors and creditors account. So starting with this, these are the opening figures of debtors and creditors because our accounting period starts from 1/1/19 and this is 31st December 18. So these are the opening balances. So in debtors, it would be debited, 2 balance brought down, 1,25,000, and in creditors, by balance brought down, creditors is 85,000. So these are your debtors and creditors figure. Next, bills payable and bills receivable. So what we'll do, first we'll do all the suppliers transaction, that is creditors transaction. For creditors is always bills payable. What is your entry for bills payable accepted? So when we accept the bills payable, our entry becomes creditors to bills payable. So in your creditors account, it will be debited to bills payable. So for this much amount, it is transferred from creditors to bills payable, 20,000. Then we have goods return. So this would be your purchase return. For creditors, it would be purchase return. For debtors, it is sales return, 5,000. Then we have discount. This would be discount received, 3,000. Remittances. What do you mean by remittances? Remittance means this much amount we must have paid to the creditors. So we'll say back to cash bank account. So cash bank would be 97,000. So that is your remittance. Dues on the date of hire. Dues on the date of hire. So this would be outstanding balance on the date of hire. Now again, these debtors and creditors account will be prepared for the same period, because we want to find out credit sales and credit purchases for this period. So on this date of hire, on 20th March 2019, dues to the suppliers is 50,000. So this is the balance to be payable to suppliers. So we say to balance carried down, 50,000. Next we'll do all the transaction with customer, that would be your debtors. Now for debtors, it would bills receivable entry becomes bills receivable account debit to debtors account. So by bills receivable, 45,000. Next goods return. So this would be your sales return. By sales return, 13,000. Next discount, 8,000. So this would be discount allowed to debtors. By discount, 8,000. Next remittances. So these are the remittances which we have received from debtors. So by cash bank, remittance received from debtors is 95,000. And dues on date of hire. So dues on date of hire, that means these amount are still receivable from the debtors. So by balance carried down, 1,19,000. So guys, simple. We have just posted all the suppliers and customers transaction over here. Next, we'll do totaling at the end. First of all, we'll post all the items which are given in the question. Wages. So wages goes to trading debit to wages. There is no adjustment on that. So directly outer column, 27,000. Then we have cash sales and cash purchases. So we can say as two purchases. Cash it is given as 12,000. Same by sales. Cash sales is given as 35,000. We are writing in the inner column because we'll add credit sales, credit purchase, and we'll find out the total figure out in the outer column. Goods sent on consignment. Now guys, these are important. Goods sent on consignment, the remaining unsold with the consignee at cost plus 10% is 11,000. Now what happened is, in this case we are consignor. We have consigned some goods to consignee. Consignee means our agent who is going to sell our goods on our behalf, and he will get commission for those sales. So there were some goods which are still there with our agent, that is a consignee. Now what happened, if the goods are still with the consignee and if it is not yet sold, this is still in the ownership of the consignor, means these goods still belongs to us. Belongs to us means Shalini Traders. But now, why we prepare this memorandum trading account? We find out physical stock on the date of hire, and these goods are not there with us, it is with the consignee. So we will have to deduct or eliminate these goods from our trading account. So what we'll do, by goods sent on consignment. And now if you see, the goods are worth of 11,000, but this is cost plus 10%. So we'll have to find out cost. So what we can do, we can prepare working note 3. Goods sent on consignment, cost plus 10% is the value of the goods, which is given 11,000. So if cost is 100 plus 10% would be 10, then the value is 110. This is given as 11,000. So what would be the cost of those goods? So it would be 10,000. If you multiply this, you will get the 10,000. And if you cross check 10,000 plus 10%, that would be 1,000, gives you 11,000. So what has happened? We have sent some goods to consignee at invoice price. This value is actually invoice price, which we have discussed in our consignment accounting sessions. So goods which are sent by consignor to consignee is with adding the profit or some margin, what we say as loading, and it is sent to consignee at invoice price of 110. But when we deduct those goods from our trading account, it is actually deducted from purchases. We have debited our purchases, so these are the goods which we have purchased. Out of those goods, some goods are sold. On the sales, we reverse our GP, so we find out cost of goods sold. So we deduct goods which are sold. So what we do, opening plus purchase minus cost of goods sold, that we find out as closing stock on the date of file. But there are still some goods which have been purchased in the year, which are sent to agent, that is consignee, still belongs to consignor, ownership is with the consignor, that is with us, but these goods are not physically lying with us. So we'll just eliminate those goods from our trading account just to find out by stock on date of file. This is our required part. So that would be our balancing figure. How much is the stock on the date of file is there in the godown of this Shalini Traders. So these goods, though it belongs to Shalini Traders, will still deduct because it is not physically there at the place of fire. So goods sent on consignment as per working note 3, and will deduct the cost. The loading is just the element, the profit which we charge or which we add on the cost to send the goods to consignee. But actual cost of goods is only 10,000. So we'll deduct the 10,000, that is the cost of goods, from this entire purchases and opening stock. Next, goods given to disaster relief fund at cost. So again, these goods are going out of the business. So credit by goods given to disaster relief fund, that is, this is at cost. So we directly take cost of 15,000. Next, goods taken by proprietor as sale value. Now this is your drawings, so we say by goods withdrawn for personal use, or we can even say as goods taken by proprietor, that is also okay. Goods withdrawn for personal use. Again in this is given at sales value, but we have to find out this at cost because goods are going out of the business which is not sold, it is just withdrawn for personal use. So this would be valued at cost. So we can find out this by doing working note 4, that is for our drawings. Now our profit margin is goods are sold at gross margin of 30% and the sales value is 8,000. So what we can do, cost plus profit is your selling price. 30% would be on sales, so profit is 30. We assume sales as 100, profit 30, cost would be 70, 30% on sales. So a profit is applied on sales, so we assume sales as 100. Next, your goods taken by proprietor at sales value is 8,000. So if this is 8,000, how much would be the cost? So just cross multiply 8,000 into 70 divide by 100. So this comes to 5,600. Or we can directly do this 8,000 is the sales value and this 30% is on sales. We can say 8,000 minus 30%. That also gives us 5,600. So instead of this, we can directly do this also. 8,000, which is already your selling price, minus 30% GP margin. That gives you cost of this goods withdrawn for personal use, 5,600. So this comes to 5,600. We can just give the reference of working note 4. So next is free samples distributed at cost is 500. Now again, goods are going out of your business. So it will be credited to trading account by goods given as free sample, and it is at cost itself. So we are not required to do any valuation of finding the cost. So that is 500. Now goods are sold at a gross margin of 30% on sales. So that we have already considered wherever we have to find out from sales value to cost. So this is the 30% margin. This will be also helpful while we find out the gross profit. So over here we can write as to gross profit. This would be on sales 30%. Stock for the balance sheet at 31st December 2018 was valued at 10% above the cost. Now this is important. So guys, this 66,000, that is your opening stock, 31st December 18. So that is your opening stock was valued at 10% above the cost. So this 66,000 is after adding the 10%. So we need to find out cost for this same, cost for this stock. So what we'll do, 66,000. Now do not do like 66,000 minus 10% because this 66,000 is after adding 10%. So if your cost is 100, then 10% is added and we had find out the value is 110. So 66,000 is 110. So 66,000 into 100 divided by 110 will give you cost of this opening stock. Or what we can do, 66,000 into 10 divided by 110 will give you the excess value or overvaluation. If we deduct that, we can find out the cost of which. So I'm doing directly like 66,000 into 100 divided by 110. So that would be 66,000 into 100 divided by 110. So that is 60,000. So we'll write over here 60,000. We can just cancel this 66,000. So what we can do, 66 minus 6, outer column 60, or you can directly write cost in the outer column. So always remember that you have to take your opening stock or closing stock or any stock at cost. Over here it was given valued at 10% above the cost. So we had deducted that 10%. Guys, if you had done 66,000 minus 10%, we would have got 59,400, which is incorrect. So 66,000 is after adding 10%. So 110 is 110, 66,000 is 110. How much would be 100? That is your cost is 60,000. So again this is done. Compute the insurance claim. Now in this question, we have already prepared debtors creditors account. We have taken all the data which is given: opening stock, debtors creditors transaction, cash sales, credit sales, wages, goods sent on consignment, that is to be considered at cost, goods given for disaster relief fund directly given at cost, so we have taken cost, goods withdrawn for personal use, withdrawn by proprietor, that was at sales value, that we also brought to cost because goods are not sold on which we have not earned profit. So those goods are going out of the business should be valued at cost itself, and goods given as free sample. So finally, while closing this, first of all we'll close debtors and creditors account to find out credit sales and credit purchases. So total this up, 45,000 plus 13,000 plus 8,000 plus 95,000 plus 1,19,000. So that is 2,80,000 minus 1,25,000. So that gives us 1,55,000. This is our credit sales. So 2 credit sales, 1,55,000. Next again close your creditors account, 20,000 plus 5,000 plus 3,000 plus 97,000 plus 50,000. So this is 1,75,000 minus 85,000. So that gives you 90,000. So this is our credit purchases. So this is our credit purchase. So we'll write credit sales and credit purchase in our memorandum trading account. So credit sales is 1,55,000 and credit purchase is 90,000. So 90,000 plus 12,000, this is 1,02,000, and 35,000 plus 1,55,000, this is 1,90,000. On this sales, there is a gross margin of 30%. So this would be, gross profit would be 1,90,000 into 30%. So that is 57,000. So that's it. We have found out all our figures. Finally, when we total, we find out stock on date of fire, 57,000 plus 27,000 plus 1,02,000 plus 60. So that is 2,46,000. So 2,46,000 minus 1,90,000 minus 10,000 minus 15,000 minus 5,600 minus 500. So that gives us 24,900. That is our stock on date of fire. So on this date, that is 20th March, we had a stock of 24,900 in our godown when there was a fire. Then from this we'll deduct salvage to find out actual loss. So stock on date of fire is 24,900 less salvage. So see the question, how much is the salvage? Salvage is 2,000 that we have marked previously, and your policy is 40,000. So less salvage 2,000. So this would be 22,900. That is your actual loss. After this we find out the claim value. Now your stock on date of fire is 24,900, against which we have some insured, that is our policy value of 40,000. Now in this case, see people, our policy is of more value than our stock on date of fire. So our stock is fully insured. In the previous question, we had a policy which was less than the stock on date of hire. So in that case, the stock was under insurance and we had applied average clause. Now in this case, our stock is fully insured. That means whatever is our actual loss, we'll file a claim for the same amount, we'll get the claim for the same amount. So actual loss is your claim amount, that is 22,900. That is our final answer. So now in this case, a difference was that they had given you policy which is more than the stock. So this is the fully insured. If the stock is fully insured, whatever loss you have suffered, insurance company will pay the claim for the entire amount, that is 22,900. So in this question, we had a different adjustment of this debtors and creditors account, from which we found out credit sales, credit purchases. Also, if the stock is overvalued, bring it to cost. If the goods are going out of your business for any charity or personal use or free sample, or if the goods is given to consignee, still lying with the consignee and physically not there in your godown, that should also be deducted from your purchases to find out the finally physical stock or closing stock on the date of hire at the place of hire. So I hope you understood this question. Thank you.